Hello everyone. Welcome to Finance Focus. What if you could turn market chaos into a tool? What if the very force that creates fear and uncertainty could be used to your advantage, not your detriment? This is the core idea behind what some call financial judo. It is a simple concept. It involves using the momentum of the market, its powerful ups, its steep downs, rather than trying to fight against them. It is not about brute force or predicting the future. Instead, it is about using calm, deliberate, intelligent choices to navigate the turbulence. This essay will show you how to apply this principle. We will explore clear, practical moves that can help you use market volatility to your potential benefit, not your financial harm. The language will be simple. The steps will be clear. Before we learn the moves, we must first understand the opponent, the force we are working with. Market volatility is simply the measure of how much and how quickly prices move up and down. On some days, the market is calm, like a placid lake. On other days, it is a raging sea. A major economic report, geopolitical news, a shift in broad investor sentiment can cause prices to jump or plummet in a matter of hours. This rapid change creates both risk and opportunity. It is a natural part of how free markets function. It reflects the collective hopes and fears of millions of investors in real time. For an unprepared investor, this environment can feel treacherous. The emotional pull can be immense. When markets are soaring, the fear of missing out, or FOMO, can compel people to buy at high prices. Conversely, when markets fall sharply, fear can trigger panic selling at the worst time. This emotional roller coaster is what causes many to lose money. They buy high out of greed and sell low out of fear. Financial judo is designed to counteract these instincts. It provides a logical structure to bypass emotional decision-making under pressure. View swings as a feature, not a bug. Think of it like the tide. It comes in and it goes out. A sailor uses knowledge of patterns to navigate. An informed investor sees declines as chances to buy lower, and rapid growth as chances to secure gains and reduce risk. Volatility is neither good nor bad. It's a force. How you interact with that force determines your outcome. The key is to separate noise from signal. Daily news is full of dramatic headlines. Pundits make bold predictions and social media amplifies every rumor. This is the noise. The signal is your long-term plan and the fundamental value of assets. Understanding volatility as normal lets you tune out noise and execute your plan. It lets you see downturns as events in a larger journey. This mindset shift is the foundation for all moves that follow. This approach is fundamentally about control. Not control over the market, which is impossible, but control over your own actions and emotions. By establishing a set of simple, logical rules before the storm hits, you create a plan that can guide you through it. This plan becomes your anchor in the chaos, allowing you to act with purpose when others are driven by fear. We will break down each move, look at real-world examples, and discuss the potential risks involved in plain terms. This is not about making promises. Our first move in financial judo is perhaps the most straightforward, yet it requires significant discipline. It is the practice of using market dips to buy with a predetermined plan. When prices fall quickly, the prevailing emotion is fear. People sell, which can push prices even lower, creating a cycle of panic. This is the moment when assets can become available at a discount. However, simply jumping in because prices look cheap can be a trap. The key is to act not on bravery or gut feeling, but on a clear, simple rule you have established beforehand. This rule removes emotion from the equation and replaces it with systematic action. One of the most effective and accessible ways to execute this move is a strategy known as dollar-cost averaging. The plan is simple. You invest a fixed amount of money at regular intervals, such as every month or every quarter, regardless of what the market is doing. When prices are low, your fixed dollar amount buys more shares of an asset. When prices are high, that same amount buys fewer shares. Over a long period, this approach can lower your average cost per share compared to investing a lump sum at a single point in time. It turns volatility into an ally by allowing you to automatically buy more when things are on sale. Another method is to maintain a dedicated cash reserve. Think of this as your opportunity fund. You set aside cash ready to deploy when a broad index falls by a certain percentage, say 10% or 15%. This is like a judo practitioner waiting patiently for the opponent to make a big move. The market provides the downward force, and you use that force to step in and buy at a more attractive price. For example, let's say you commit to investing $200 every month into a broad market index fund. 1 month, the market is down 8% and the fund's share price drops. Your $200 now buys you more shares than it did the previous month. The next month, the market recovers and the share price is higher. Your $200 buys fewer shares. You are not trying to time the bottom perfectly. Instead, you are consistently participating, and the market's own volatility is helping you accumulate more shares at lower average prices over time. The reason this first move, buying into dips with a plan, works is rooted in both mathematics and human psychology. Mathematically, acquiring more shares at lower prices brings down your average cost, meaning you need a smaller rebound to break even and move into profit. It accumulates over time. Psychologically, a rule-based system like dollar-cost averaging helps you act when fear tells you to run. This strategy relies on the long-term upward trajectory of well-diversified markets. Historically, markets recover and reach new highs. While past performance is no guarantee, buying weakness is a bet on human ingenuity, economic growth, and the enduring power of innovation. You are essentially taking the other side of the panic trade. When others sell out of fear, you buy with belief in long-term recovery. However, it is crucial to be clear about the risks. The primary risk is that you can buy too early. A market down 10% can fall another 10 or 20. If you invest all your cash at the first dip, you may have nothing left if declines continue. Buy in small, planned increments across different price levels and times. This strategy is not suited for troubled individual stocks. A falling price can signal fundamental failure. Apply it to broad, diversified investments like index funds and ETFs representing markets or sectors. You're betting on the economy's resilience, not one company. Always adhere to your plan and never invest money needed in the short term for life's necessities. Our second move, rebalancing, is a powerful form of financial judo that forces you to sell high and buy low without ever trying to predict the market's direction. It is a simple maintenance routine for your portfolio. You decide on a target mix of assets, such as stocks and bonds. A common example is a 60-40 portfolio. Over time, markets move and your balance drifts. Rebalancing brings that mix back to target. If stocks have grown to 70%, you sell some stocks and use proceeds to buy bonds. It feels counterintuitive, selling winners, adding to laggards, but that's its power. Think of it as using the market's own force against itself to lock in gains and redeploy into relative value. You're not predicting. You're maintaining your desired risk. Start with 60,000 in stocks and 40,000 in bonds. After gains, stocks are 84,000, total 124, nearly 68% stocks. Sell about 9,600 of stocks and buy bonds. You've locked in gains and added to bonds at relatively lower prices. Rebalancing works for a simple reason. It automates the behavior of a successful investor. The core principle of investing is to buy low, sell high. The challenge is, emotions make us do the opposite. Rebalancing provides a mechanical rule that forces you to trim winners after a strong run and add to losers after they underperform. It's not traditional timing. You're not picking tops or bottoms. You're harvesting gains and redeploying while keeping risk consistent. Start moderate at 60-40, let stocks swell to 80%, and you're unintentionally high risk. Rebalancing is the governor. It prevents overexposure and aligns with your risk and goals. First, taxes. Selling winners in taxable accounts may incur capital gains. Prefer rebalancing inside tax-advantaged accounts like a 401k or IRA. In taxable accounts, direct new contributions to underperformers. Keep frequency simple. Rebalance on a set date yearly, or when an asset deviates by 5 or 10%. Our third move ventures into slightly more advanced territory. It involves using specific tools like stop orders, like options, to manage risk during volatile periods. These are powerful but not for everyone. They require understanding and can cause harm if used improperly, like complex throws without proper training. Before using real capital, educate yourself, practice small, or use simulations. A stop order automatically sells if price hits a level. Own at $50, stop at $45, trigger at $45, then fills at next market price to limit potential loss. Buying a put gives you the right to sell at a strike, insurance for a premium. Useful, but gaps can slip stops, and option premiums can expire worthless and drag returns. Tools demand clear objectives and respect for downsides. Beyond moves and tools, the single most important element is a calm and disciplined mind. When markets scream, your greatest asset is steadiness. Panic narrows focus, shortens horizons, and compels emotional action. Financial judo is not just knowing, it's having the fortitude to act under pressure. Build your financial house on simple, unbreakable rules. A rule is a specific instruction. I will invest $200 on the 15th monthly. I will rebalance January 1st. I will keep 6 months cash. Filter information. Ask, does this change my long-term outlook? Is it panic or structural shift? Most drama is a small blip on a multi-decade journey. Discipline strengthens with practice. The first storm is hard. Holding firm builds confidence. Next time, it's easier. We have discussed the philosophy of using the market's force rather than fighting it. We have walked through 3 concrete moves: buying dips with a disciplined plan, rebalancing to sell high and buy low, and carefully using advanced tools for protection. The core idea is calm, rule-based action superior to emotional, panicked reaction. Over time, steady, deliberate steps turn volatility into opportunity. It's a steady practice for durable wealth. The journey does not require a giant leap. It begins with a few small, deliberate steps. First, create one clear rule for downturns, DCA plan, or a cash reserve deployment rule. Write it down. Second, define your target allocation. Set a rebalancing rule, time-based annually, or trigger-based at 5%. Third, if interested in protective tools, learn first. Knowledge must precede action. Finally, practice remaining calm. Investing is a marathon. You cannot control the market, but you can control your response. Use simple, steady moves to ride volatility and reach your destination. The power is in moving with the chaos, calmly and intelligently. Thanks for watching. If you enjoy this video, please don't forget to comment, like, and subscribe for more amazing videos.